All right, welcome back. Welcome back. It's a fun time. Oh, before we start, let's show us your face with two thumbs up. Love to take the screenshots, and this is one of. All right, all right. Welcome back to the main room. So, Nico, who do we have today? I know we have an amazing guest, and we're gonna have a ton of fun today.
Yeah, so all right, this is my man David Frasz. Now, I don't have a bio for him, or I have an older one, which I'm not going to read. He was on here before, and I requested that he come back because of everything that's going on in the lending environment is very tricky for us as investors to decipher and to figure out what's going on, and for underwriting purposes. And I I hit a wall. I was underwriting completely wrong and sizing up deals completely wrong. And when I had a conversation with David, a very long conversation with him, he set me straight, and I said, this has to be seen by everybody or else we're going to run into the same problems. And I don't want you guys to run into these problems. So David's going to talk a little bit first about himself, and then he's going to share a little bit about what's going on in the market right now with debt and lending, what we can expect. And obviously nobody's got a crystal ball, but he'll give us his view. And then he's going to, we're going to kind of look at a deal, and we're going to set our underwriting straight for all of you guys. We'll use the synthesis and analyzer that a lot of you use and know, and we will set it straight. So David,
Great.
Welcome, man.
Thanks, Nico. I appreciate it. And Joseph, I appreciate you guys having me on.
David, sorry. Throughout conversation, if you have any question, you can type it in the chat box or wait until David is done, and we can have a Q&A session too, okay?
Yeah, definitely ask all the questions that you guys have, because this is certainly something that every deal that you guys are looking at is a little different. So we're going to go through one that Nico and I had looked at a while back, but the situation is certainly not unique to him. I'm sure you guys have all been in situations where you're sizing up a deal and it sounds great, and then you get a quote back from the lender and they say they're not able to get to the loan amount that you thought you were able to get to. Yeah, ask away. You guys can put them in the chat, or I'll pause and see if you guys have any questions. But I don't want to talk too much about myself, but as Nico said, I'm a direct lender, focused primarily on agency lending. So I work primarily with direct investors, and we also do bridge financing as well, which is right now one of the things that will come up as we're talking is a lot of deals are only working as bridge loans, and that's because of the way we have to size loans for Fannie and Freddie. I guess, Nico, should I just share my screen and we can walk through this deal, or do you want to share yours?
I can share either one, but what I would also like, if you have some idea or discuss a bit, I guess, where rates are right now, more or less.
Sure.
And then we'll hop into them.
So yeah, that's a good point. So everyone obviously is somewhat aware of kind of where rates have moved, or at least the direction they've moved, and everybody knows it's been up. They've moved up really significantly since 2021 in a way that we haven't really seen as long as I've been in the industry. Rates are pretty much where they were in 2018, but in 2018, it took them about a year to get to where they were. And really, we're looking at 60 days to get to where they are now over the last 60 days. So, let me just, you guys all see my screen, or?
Yep. Yeah, we got it.
This one?
Yep. With the 10-year treasury.
So yeah, so this is where we are right now. We're about just looking at the 10-year, and there's our loans, if it's a 5, 7, or 10, they're based on the 5, 7, or 10-year treasury note. When you're talking about the index rate, and these are all the fixed rate indexes, but you can see where we are relative to where we were in December. We were at about 34 basis points, 140 basis points in December. And you can see pretty quickly we doubled that. And if you go out 5 years, you can see we're basically where we were back in the end of 2018, early 2019. But as you can see, the rise was much slower. And so there was a lot of absorption that was able to happen as investors like yourselves were buying deals, putting offers out there, going through the loan process, which obviously doesn't typically turn itself around in a week or two. So being subject to interest rate risk is certainly an investor's nightmare, which is one of the reasons why the Freddie Mac Small Balance Program is great, because we can lock in that rate up front at the time of application. But if you're subject to the Treasury movement or even spread movement from Wall Street, like on a Fannie Mae loan, you're going to be in tough shape. And I actually have a client where we went under application and the rate was just below 5%, already pretty high. That was maybe 2 months ago. And now his rate is over 6%. So it's been an ugly turn of events. And like I said, haven't really seen this as long as I've been in the industry, which is coming up on 10 years. So yeah, rates haven't been good. Floating rates are moving too. You're going to get, if you're looking at bridge loans, you're going to have a lot of lenders quoting floating rate terms. But the thing to remember is that floating rates are not looking out as far when they're pricing, when the lenders are pricing floating rates, they're not looking out as far into the future, because the rate can move and they know that. So floating rates might still be fairly low, but they can increase very quickly. So you got to weigh the risks of locking in a fixed rate that you're not really thrilled about, or shouldering that risk over the next couple of years in a bridge loan scenario with a rate that could easily surpass the fixed rate that you might get. So we do have a fixed rate bridge product that goes up to 10, 15 million. And we're seeing that get a lot of attention. I think that's probably it on rates, unless anybody has questions. Nico?
Yes. Well, so that's where,
any good questions?
of course, yeah. So that's where we are. Now, when we're underwriting with the bridge product, it's very hard to know where we're going to come out of and how we're going to come out. It's also going to be, as you and I have discussed, market specific, depending on what LTV we're coming out with. So all of that is also TBD, and people need to speak with lenders frequently about their game plan, their business plan of how they're going to come out of these bridge products. And I'll tell you, I got to be honest with you, everything that I'm underwriting is bridge right now. There's no other way around it.
Yeah, most deals that I'm seeing right now, most acquisitions are coming in and really not penciling out much higher than 65%. It's kind of just the way it is right now. And part of that, again, is rates have risen so quickly that we'd be able to get to 75, 80% if we were using rates from 3 months ago. But using rates today, sellers haven't really reset their expectations, and buyers haven't been able to really catch up by lowering their offer prices and still being competitive. So you're seeing a lot of deals coming in at the high prices we were getting used to. Only now rates are 100 basis points or more higher. So it's thrown things out of whack pretty significantly, which is leading all of you guys to have to look at bridge debt, even though you might not want it to begin with. But yeah, forecasting. I mean, like you said, Nico, nobody has a crystal ball, myself least of all. So I think the best thing you can do is make sure that you're not projecting rates that are too low coming out of your bridge loans or whatever your business plan is. If it's a perm that you're going to refi out of or something like that, I think you could really put yourself in a tough spot if your deal being successful depends on the exit rate being 4.5% or something like that. So of course it could go back down just like it did in 2019, where after it reached a high at the end of 2018, it kind of fell for 2 years. But that's a risky business. You don't want to end up underwater.
Question.
Sure.
Do you see the situation that we're in right now, like the situation that was in, I'm sure you're familiar with 81, and then sometime I forgot in the 40s, where they had, it was like 6 to, I believe it was 8 interest rate hikes throughout that time? Or do you see it being like a different situation than before?
Well, what they're saying is they're going to have a similar number of rate hikes. I think that we'll have to see, because I think, especially over the last several years, I mean, we're well out of the 2008 recession, and the Fed has been super unwilling to raise rates for 10 years. So it's I know they've been talking about raising the rates and keeping them going to push off inflation and that sort of thing, but I think they'll also jump on any excuse to not raise rates if they have one. And we've got international conflict in Europe, and we've still got a COVID epidemic that's all around the world that could come back at any moment and put people out of work and things like that. So I'm not sure we're going to see all the rate hikes that they're projecting, but that's what they're saying. So that's kind of the best I think any of us have to go on.
Sweet. Thank you.
All right, let's do it, man. Let's jump into let's look at the analysis.
One last thing I'll say on rates too is it's important to remember that all of the changes in rates that you see in commercial lending, it's all determined by Wall Street, essentially. And so you have these large institutions that are trying to hedge their funds, and they're trying to not lend at, no bank wants to lend at 3% and then rates go up to 5%, 3 months later. So there's a lot happening with projections at that level on Wall Street. And depending on, how optimistic or pessimistic the analysts are that are preparing the data for the capital markets teams at all these many institutions, that's what goes into the aggregate kind of movement of rates that you see. So some weeks, some days it's overblown. You'll have a money manager that just won't buy our loans for less than whatever spread of XYZ, and so that basically just pushes up rates. It's supply demand market forces at that level as well. So it's just important to remember that people in those positions are doing the same thing that we're all doing and trying to figure out what's going to happen in the future. And everyone's perspective on that is a little different. So that's why you see the volatility, even though, the Fed has only made, 1 move or 2 moves or 3 moves or however moves they end up making. You're still going to see volatility that moves rates in different directions based on what the capital markets folks are actually seeing day to day. So Nico, you want to share your screen and walk me through the model? You're more familiar with the model, and you know exactly what we want to pinpoint.
Yeah, no problem. All right, here we go. All right, so what's important to remember here is that the way that a lot of these models, and David's going to tell us, are set up, I'm not sharing it by the way, is that we are basically looking at when you're looking at your debt service coverage ratio, it's not going to be how a lender or how David will look at it. So let's just take a peek at this. And it's important to know because that can significantly change things. All right, here is a deal. They were asking 5.2 million. And David, you direct me, but
Yeah, so I think the overarching thing to keep in mind is my goal of being here, and I think hopefully everyone else's goal when they're taking notes or internalizing this information is ideally we want the way you're underwriting your debt assumptions to line up with mine. So over the course of several deals that I've worked on with Nico, his numbers and my numbers are getting closer and closer and closer. And the point, my goal is to get him to the point where he doesn't have to reach out to me until he has a deal under contract, because he already knows that he's underwriting it the way I would underwrite it, and he's got it sized and he's reached out for kind of an estimated ballpark interest rate. He's giving himself a little cushion, and the deal works. And so he's putting in his offer, and he doesn't have to really circle back with me until best and final, or maybe he's got something under LOI. So that's kind of the goal. And one of the challenges is, and I see it every day, is investors are using different models, and some of the cells are calculating in ways that actually aren't calculating a number that it says it's calculating based on how we would look at it from the lending side. So just to start out with, I think if you look at that center column, the debt up the top, Nico, so you've got, obviously it's very important to understand the amortization that you're going to look for. And agency, we're going to be at 30-year amortization. Banks will be at 20, 25 year amortization. Obviously that reduces the amount of going to 30-year amortization, reduces the amount of principal that you're going to pay down over the term, which is generally not going to be 30 years. It's going to be 5, 7, 10, something like that. So the longer the amortization means lower payments. Obviously rates are important. You want to have a good ballpark there. And I think high fours is probably on a $5 million deal is probably as low as you're going to want to estimate right now, just to give yourself some cushion. I mean, we just saw a 35 basis point increase in rates with Freddie Mac this week. So if you were underwriting 4.5, you'd already be at 485 in literally a matter of one day. So I wouldn't want anyone right now to hurt yourself by going too low. So I'm telling people to pencil in about 5%. If you're in a smaller market or you have a much smaller deal than this, you might even go up to 5.5% right now, which sounds terrible based on where we've been over the last couple of years, but it's a new reality that we're in. Your down payment, most of you probably know that in most markets, you're going to be looking at, Fannie Freddie debt that can get you to 80%. So that's kind of generally our maximum LTV is 80%. Some smaller markets, you might be at 75% on an acquisition. But that's kind of the upper bound that I would expect in most markets with an agency deal. That being said, the big thing that we really want to discuss here is the debt service coverage, because I think that's one thing that I get a lot of calls from investors saying, what would I have to put down? What would I have to put down? 20% or 25%, or is it more? And that's a really difficult question to answer if I haven't sized the deal. So I can tell you what my maximum LTV is, which I might say 80, as it was on this deal, or maybe it was 75 on this deal. But so I could give you my maximum LTV, but that doesn't mean the deal actually sizes to that. If you've got big goose egg for income, then you're not going to get anywhere close to 80, right? So calculating the debt service coverage involves a couple of different things. Obviously, it involves the rate, involves the amortization, but it also, the interest only plays a role. And then the way you've underwritten your income and expenses play a role. So the reason interest only plays a role is because a lot of investors come to me and they are saying that their deal is cash flowing like a beast. It's a 2x debt service coverage ratio. But what it really is their model is set up to tell them what the debt service coverage is in year one based on the debt payment schedule that they've got. Well, if they have 1, 2, 3 years of IO plugged into their model, it's going to calculate the debt service based on the interest only payment. And we don't do that. So we calculate debt service coverage based on the full principal and interest payment. So that's going to throw you way out just by adding in the interest, or the principal, which is going to be easily, 45 to 65%, of your payment. So, Nico, if you want to scroll down, just show them the table that you created and how that plays in with the model, because you're familiar with the model more than I am.
Yeah, so this is the model. This is basically where it ends is, they're at this asking price, we are seeing a 1.41 debt service coverage ratio. We think everything is great because we need basically 1.3, 1.35. Is that what we need right now? David?
I'm sorry, say that again.
You basically want to see a 1.3 debt service coverage ratio. Is that right?
I think this deal was in a small market. So yeah, we would have been at a 1.3.
All right, so now this is what this model is showing, which is really based on pro forma year one. So 1.41 looks great, but here's what when you and I worked on how you would size it, but this is where we really are. And this is, I just added these calculations in here for me to kind of understand.
Yep. Yeah, so exactly. So underwriting 101 is obviously for you guys to determine what your returns are going to be on a project. You're going to look at, what you can take the rents to, how much money you have to put in to get the rents where they are, what you're going to do. You're going to bill back for water, or you're going to add parking income, or you're going to do all these things to increase the income. And you may also drive down expenses. Maybe the seller is paying 7% per management, and you're going to come in and pay 3 or 4%, or they're, providing free cable to all the tenants, and you're going to scratch that, or you're going to renegotiate the trash contract, or trim some payroll that you don't need, or something like that. So a lot of different things there, and that's fine on the expense side. But the point to remember is that when a lender is sizing the income, kind of a top line income, gross potential rent, economic vacancy, so concessions, bad debt, what's actually coming in, other income, they're going to look only at what's in place. So quick rule of thumb would be take your trailing 3 income collections, and your collections items are going to be your gross potential rent, your bad debt, your concessions, and your vacancy. So you take the net of those 4 items, and take it over the T3 and annualize it. And that's where you might start from your rental income. And then you're going to just take your existing in place other income, which could be significantly lower than what you think you're going to get even a couple months into your deal. But that's what the lender is going to underwrite to. So you take those, that's your income, and then you have to make adjustments to your expenses. So for example, everyone's probably familiar with this, but on taxes, I just looked at a deal today that's at $40,000 in taxes, and I spoke with an appraiser, and the appraiser says it's probably going to be closer to $120,000 a year in his analysis. So that's what we're going to underwrite to. And so whether it's 85% of the purchase price, or it's some other calculation that you can only know based on what market you're in, you got to make sure you're doing a tax analysis there. The other thing is insurance. Insurance has been increasing everywhere across the country. Hard hit markets like Texas and Oklahoma, where you guys have hailstorms and things like that, markets like Florida and Houston, where you guys have hurricanes. Those markets are seeing huge increases in insurance because of flood and other specific perils. But it's happening all over the country. So it's important to make sure you get with your insurance agent and don't just take the seller's, $100 a unit insurance number, because especially with agency, that's not going to fly because we have specific insurance requirements. And I'm happy to send those to anybody that's interested if you want to forward them to your agent on a deal. So those are the big ones that we kind of see throw deals off pretty often. But you also want to make some reasonable assumptions on your variable expenses, like your payroll, your payroll management, R&M, and admin, kind of the main four categories of variable expenses. Again, if a seller is operating the property with no administrative expenses, no advertising, no professional fees, that's not how the lender is going to underwrite it. So your back of the napkin might be to take the trailing 12 NOI and try to back into a reasonable cap rate, but that could be wildly different once you start changing the expenses to where they need to be. So that's kind of just the basics on the expenses, and Nico might want to flip over to the other tab where it shows his income and expenses. But essentially, if you do that, like we did on this deal, you end up with a debt service coverage that's less than 1. So that's a tough sell for an agency lender.
Yeah, I'm going to have you repeat this at some point, but essentially what everybody needs to know is that we're taking the actual in-place income, right? So when you go to the rent roll, you take their actual in-place income, you actually add, you have, as agency, you have to add 5%, right? Vacancy. Your
Minimum
5%
Minimum.
vacancy.
If it's performing better than that, if your trailing 3 collections, let's say, is showing, what's the difference there? 434 minus 21. So yeah, if you're like, 410,000, 413,000, and your trailing 3 collections annualized is 413 or better or something, then we would just use 5%. But if there's a lot of bad debt, if the seller's really mismanaging the property, or there are tenants that aren't paying, or they're offering massive concessions to keep the building occupied, that number can creep up pretty quickly. And I've seen deals that are, poorly managed and they're operating at 10-15% economic vacancy. So make sure that you're tracking with what the actual collections are, not just a 5% plug if the property is underperforming.
Got it. Okay, so we're going to take that number, right, the actual income, and we're going to compare that against the pro forma expenses, which is very different than the actual expenses, right?
Right.
And it's also very different than the pro forma income and the pro forma expenses. And that's what the models show us at the end of year 1. What we're going to get is this debt service coverage ratio. That's what we hope to get at the end of year 1. But what we need to know is going in where we are right now. We're at 0.86.
And Nico, is that 141 based on IO or no IO?
Okay, great point. That's based on IO.
That matters as well.
Yeah. So if we take it, so let's remember that number 141. We're going to take out that IO. Let's see what happens here. Debt service coverage ratio just dropped significantly, and so did it here. And that's
I mean, I don't want to be too repetitive, but that's exactly the point to hammer home, is that just by changing the analysis with 1 year of IO or 0 years of IO, because that cell right there is telling you what your 1 year debt service coverage is, that cell is based on the payment that somewhere in the background of this model is pulling based on whether you have IO or not. So what you would want to do is you would want to have some sort of table, either something like Nico has over here, or you'd want to create another tab or something, but you would want to run the debt service coverage analysis with the principal and interest payment, so that you know, hey, this deal at this loan amount should qualify for an agency loan at a 125 or a 130 or whatever. Because if you don't, if you're calculating and you're making your offer based on a 140 debt service coverage, and then it turns out you're only at a 102, well, Nico, what do we have to do in order to get that 102 up to a 130?
Yeah, so now we're gonna have to put down more money. So let's do it. Let's go to 40%, see where we are. There,
Yeah.
that's getting us kind of there.
Exactly. So the difference between a 1.0 and a 125 or a 1.0 and a 130 debt service coverage is a serious amount of equity. Because you have to reduce the loan amount until you can qualify at that 125 debt service coverage. Now, obviously, if we trim the rate a little bit, if we're able to, come in 10 or 20 basis points on the rate, that helps. So that takes us in the other direction. But ultimately, these are assumptions that, again, Nico would not have wanted to make an offer thinking he was gonna, his returns were gonna be at, 15 IRR, 18 IRR based on 25% down. And then he realizes he has to come up with another $300,000-$400,000 and the returns drop off a cliff. So that's why it's important, especially, back of the napkin to figure out whether you even want to look at a deal makes sense. But if you're going to put an offer in, I have a theory that a lot of the deals that have been trading over the last couple of years at these really high prices are trading with people that are putting their offers out there before they've really dialed in on the debt. And so what happens is they get an accepted offer, they go under PSA, and then they find they have to do bridge debt, which is fine, but there's a lot more risk associated with a bridge loan. So it's great for a lot of business plans. It might be preferred in with many, but it's not for all. So you just want to know what you're getting into. And Nico, your table below, you added in the debt yield too, and I think that's probably an important conversation to have at this point too, because on this deal, once we reran your numbers, we realized it wasn't going to be an agency deal, but you couldn't just come up with another 15-20% equity because the returns disappeared, right? So
Yeah, exactly. Yeah.
So when we start looking at a bridge deal, bridge loans, we size them a little differently. There's no debt service coverage ratio going in on a bridge loan. We make sure that on exit, the rents are supported, the valuation, the ARV that we think we're going to hit, we make sure all that stuff is supported so that we can exit into a permanent loan with a debt service coverage that it meets the market. But going in, we don't look at that because bridge loans are, you might have a 50% occupied building and you might want to get a bridge loan on it, and you're going to put in work and that sort of thing. And so most bridge loans are going to have a debt service reserve, actually. You're basically going to escrow for the interest payments. So what we're going to do, most bridge loans are going to size to a minimum debt yield. And generally, once your debt yield starts creeping below 4.5%, you're going to want to really dial in, because that 4.5%, once the lender gets a hold of it and the underwriters start cutting through the numbers, that could go down to 375 real quick. And 375 debt yield is pretty low. I don't know that I've seen too many of those get done. But the debt yield, for those of you that aren't familiar, it's basically just the NOI divided by the loan amount. So it's basically the yield on the debt, the revenue that the property generates divided by the debt. So again, your underwriting matters, and you want to underwrite it the way a lender would. And we would generally underwrite the going in cash flow, the going in, not year one, but like the in place going in cash flow the same way that we just mentioned. So you'd want to adjust for taxes, adjust for your insurance, and then you'd want to make sure that you had reasonable pro forma expenses that were supportable by the lender and the appraiser and that sort of thing. You don't want to be too conservative because you don't want to shoot yourself in the foot. You obviously want to win a deal. And if you have a lender like myself, I'm going to help you get as aggressive as we can while still knowing that we're going to get the deal done. So because that's the end goal. So on anything that we've talked about, does anybody have any questions? Because I feel like I've been talking a lot and I want to make sure people can pipe up if they have questions.
If you have any questions, you can unmute yourself and speak up. Or maybe you're recovering really well, David.
I know I didn't. So there's got to be some questions.
I have one question.
Sure.
Hi, David. So
Hi.
for the agency loan, I know there is some agency loan which can cover the CapEx. Can you explain a little bit? Just like
Sure.
to see, because some of the renovation definitely either we get the loan or raise more money. Like,
Yep. Yeah, I'm really glad you mentioned that actually, because that's something that over my career has been kind of a selling point that I was an underwriter previously, so not all originators really even know about the ability to do that with Fannie Mae. And it's kind of a kind of niche underwriting to a Fannie Mae loan. And I used to do it all the time. And it's great when you have a borrower that, for example, I think I'm doing one right now, but the last one that I closed was a few months ago, and it was, call it a $6 million loan. But the buyer was buying the property for 7 or 8 million. And we basically provided $1 million in rehab money. And it wasn't a bridge loan. So they have a fixed rate. They have a 10-year loan. They got interest only for the first couple of years, but we also were able to give them a $1 million budget to spend. And that's great, but it still has to, at the higher loan amount, adding the additional $1 million in CapEx or whatever the amount is, it still has to underwrite at the required debt service coverage. So on that deal is a 125. On this deal on the screen would be a 130. Even though we were looking at this with Freddie, so it wouldn't, it wouldn't have been 130 anyway. My point is, whatever the debt service coverage ratio requirement is, it still has to meet that at the higher loan amount, which obviously sets a higher bar. So if you're at a 125 and you're only getting to 79% LTV, we're not going to be able to add in CapEx money because you're already at the limit, and adding to the loan amount would only reduce the debt service coverage ratio. So it used to be a really great product. It's not going to work right now, unfortunately. And the reason is just valuations. I mean, I won't say that as a blanket. I apologize. You need to find a special deal. And if you find a deal where that works, you don't want to lose that deal. Because that means you're getting a very good price for that deal relative to what everyone else is paying for deals. And obviously we'll be able to give you additional leverage on that because your cash flow on that deal is so strong. So, but I'm not seeing that very much at all. I have one deal where I am about to close it next week. We did that. We built in $200,000 to a $1.4 million loan. And this happens to be up in Maine, which is a very high cap rate market. So the debt service coverage is when we started the loan, it was a 170, which is pretty high. And now we're still at a 135, even with the increase in rates. So you don't see that very often, and you're not going to see that in most of the metros around the country that deals have been trading, and there's a lot of demand and a lot of you investors chasing deals that are competing against each other. The Dallases, the Atlantas, the Florida markets, the Oklahomas, Ohio, all these markets that are seeing a lot of investor activity, the prices are just bid up too high to make those deals work.
yeah, thank you.
I see Lens raise a hand. So Lens, why don't you unmute yourself and ask a question?
Hey guys, yeah. Hey, what's up, Dave? I got a
Hey,
question for you
Lance.
guys.
Good to
Hey,
see
what's
you.
up? How are you? Yeah.
Good.
All those emails going back and forth. Hopefully, I get a deal soon. We could work on
Yeah.
something. So
Yeah.
I got a question for you, right? With competition fierce, pricing, going super high. And I'm sorry if you covered this already. What are the odds that Fannie or Freddie introduce a 40-year amort fixed rate note to kind of help affordability? Do you see that in the pipeline or
It's
no
an
way?
interesting question. I have not seen or heard anything about that. Fannie Mae does offer a 35-year amortization. I don't want you guys to all get too hooked on it because there are requirements on how much business you've done with Fannie Mae in order to qualify for it. But they do offer a 35-year amortization in certain instances, and you basically have to be a select borrower. So if it's your first couple of deals and it's a small balance transaction, it's probably not going to happen. If you've done 100 million in the last 12 to 24 months with Fannie Mae, then we can probably get that done without too much trouble. But that's something that is becoming more talked about, and it has. I mean, it's the idea has been floated several times in the last couple of years, but I haven't heard anything about the agencies actually instituting a longer amort.
And what's the minimum loan amount on that 35-year amort product typically?
I actually don't know the minimum, but I mean, I would imagine it would have to be north of 10 million probably.
Gotcha. Yeah.
Unless you, again, would have, you'd probably have to be a borrower that has done a significant amount of business. Like there are certain channels with Fannie Mae for borrowers that have done hundreds of millions of dollars with them. So once we get there, Lance, I'll get you that 35-year
Well,
amort.
I think I got to get there first.
It only takes one.
That's true. I got it on this deal with a HUD loan recently, a
Yep.
40-year amort. It was 2020 new construction down in South Carolina, killer deal. And these guys just got a 40-year fixed HUD rate loan, and I was just so surprised. I didn't even know they existed, but definitely made that deal work. And
HUD's
amazing
different. Fannie and Freddie is what I was speaking to. HUD does have the longer amort periods, 35 and 40. You said 40. You don't see that very often, but
no, you don't.
So yeah, HUD's a great product. You also get higher LTV, and if it's an affordable deal with some sort of project level affordability, like a HAP contract or a LURA, you can get up to, I think it's like 90 or 93% LTV. So we are one of the top HUD lenders in the country. We do several billion of HUD loans every year. So happy to look at that. The challenge with HUD, just for everyone on the call, is it's hard to do really small balance loans. I mean, it's really hard to do a HUD loan on a $1.6 million loan. It's just it's a long process. Even the quickest HUD loans are going to take 6 months. And if you're doing a HUD, affordable HUD loan and it's an acquisition and there's other stuff going on, it could easily take 12 months. So those loans are tough ones to find any lender to bite off if they're that small. But if you're doing a $5-10 million deal and you've got a seller who doesn't really care how long it takes, go for it. Or certainly on a refi, that's a good time if you're coming out of a rehab program and you want to keep the property long term. Refinancing into a HUD loan when you're just sitting on the deal anyway and you have the time to go through the process, it's a good time to look at HUD.
Yeah, that makes sense. Yeah, that HUD deal took like 6 months to close, and yeah, it was definitely a long process, but I'll definitely keep that in mind. I appreciate the information.
Yeah, and I have some data sheets on some of those more nuanced products too, like the HUD stuff, which is very different than Fannie and Freddie. So I can send stuff that you send that stuff your way if you want it.
All right, cool. Thank you.
All right, any other questions?
Nico, I was thinking, I know, at least I assume that many folks on the call are familiar with this model, but you and I have obviously spent a bunch of time going back and forth over a number of deals, and I think you've probably made some adjustments or had to, make note of a couple of things. Obviously, that cell, what is it, I-36 is one of them. But if there are other specific cells that you think would be valuable to point out to folks that are using this model, just so they don't get themselves into trouble by, all the information in this model is accurate. It's just you have to know exactly what it's pulling for what purpose, right? Like, so the year one DSCR on IO, it's giving you the right answer, but that's not the number you're going to use for seeing what you can get for an agency loan. So are there any other cells or any other tables in this model that you think make sense to talk about and highlight for people that are using it?
I think just to kind of, we were briefly speaking about the bridge product. I think that it's important to know that when you go to the P&L tab, everybody, if you're doing a bridge, David was talking about a debt yield. And now to get out of that bridge product, you have to be at a certain, this isn't set up right now as a bridge product, but you have to be at a certain debt yield to even qualify for Fannie Freddie on your exit. So like, let's say we were here and trying to exit, or here, and the debt yield is 6.65. David, could we get out of this into a Fannie Freddie product?
Yeah, good point. So yeah, so when you do a bridge loan, they're going to look at the in-place debt yield to kind of, it's basically a sanity check on whether the deal has legs. If the debt yield's too low, it's gonna lead to different credit decisions on a bridge loan. Other than that, it's going to be sized primarily to loan to cost. So bridge loan, our bridge loans, for example, are kind of 80% of purchase price, plus we will fund 100% of your capital improvement budget. So whatever your numbers are, that basically that loan to cost metric is going to be how you size the deal going in. But the analysis on making sure that we do a max bridge loan at 80% of purchase price and 100% of CapEx, we want to make sure that our total loan amount can be refinanced 2, 3, 4 years from now, whenever the bridge loan matures. So in order to do that, we obviously, when we're doing a bridge loan, we need to get a 3, 4, 5 year cash flow pro forma so we can see, say in this example, in year 4, what is this deal going to look like with the new rents, the new expenses, the new taxes, all that jazz. And so we're going to size the debt service coverage on a takeout, and we're going to size, obviously, make sure the loan to value makes sense. So if the ARV that the borrower is projecting is $300,000 a unit in Central Oklahoma, that's never going to value out, and we need to make sure that gets to 70% or so loan to value on exit. So it's the debt service coverage, the loan to value, and then the third one is the debt yield. We want to make sure that the loan exits at a debt yield, which is a debt yield on the current loan. So you might start off at 4.5% going in debt yield. We want to make sure generally that it's 7, 7.5, 8 debt yield on exit. So this one, just that cell that Nico's got highlighted, is a little bit low. Obviously, this deal isn't set up, or this model isn't set up to really size out this bridge loan. But if we were looking at a 6.6% debt yield on exit, that would basically say that there's actually not a whole lot of cash flow growth, or not as much cash flow growth as we would like to see to get us comfortable on the exit in year 4.
Perfect. Joseph?
That is Absolutely amazing presentation, David, for today. Got a lot of nuggets and a lot of information. I really appreciate that. If anyone has any more questions, time's up. So we're gonna close for today. Thank you very much for joining tonight. We learned a ton of good stuff today from David. And David, thank you again for coming and dropping the bombs.
Sure thing. Yeah, Nico, do you want, or Joseph, one of you want to share, or I guess I can do it. I'll drop my contact information in the chat for anybody that wants it.
Please.
Happy to help you guys with any deals, but of course also happy to help you guys get your underwriting models straightened out, because like I said, there are a lot of different models out there, and not that they're not correct, but sometimes the information, it's more geared towards what can I get as a return on this deal, and it underappreciates the impact that debt has on a deal.
Also, we're gonna send out, well, you can check out David's chat, but we're gonna send out your contact information as well through email after this
Okay.
with the recording. So
Sure.
everyone can get that.
Well, I appreciate everyone bearing with me. I know Nico said we were going to have a lot of fun, and maybe for some of us it is, but I'm sure it's pretty dry for everyone else. So I hope you all got some good stuff out of it, and hope to hear from some of you guys soon.
What are you talking about, David? It was so much fun. We all enjoy underwriting, right?
Well, if you guys are doing, underwriting 4 or 5 deals a week, like I'm probably sure some of you are, I hope you enjoy it.
Thank you very much, everyone, for coming again. We will see you next month.
Thank you.
Thank you guys. Appreciate it.
Thank you.
Thanks, everyone.
Thank
Bye.
you.
Bye. Bye.